Picture this. A guy in Ohio buys a beat-up storage facility for $2 million. No employees, no customers walking through a lobby. Half the units are just dirt lots with a fence around them. 5 years later, he sells it for $6 million. He didn't build anything new. He didn't invent a product. He just rented out empty space to people who couldn't bear to throw their stuff away. That's the whole business. And it might be one of the quietest ways to get rich in America. Self-storage is one of those industries nobody thinks about until they need it, and then suddenly they need it badly. Divorce, downsizing, a death in the family, a cross-country move, a garage that got too full. Life creates chaos, and chaos creates demand for a locked metal box you can throw your problems into for $60 a month. That emotional, I'll deal with it later mentality is the entire engine behind a multi-billion-dollar industry. Today, we're breaking down how it actually works, the real numbers, the hidden costs, who actually profits, and why so many people get into this business thinking it's easy money, only to find out it's a lot more complicated than throwing up some metal buildings and waiting for checks to roll in. Let's start with the basic model, because it's refreshingly simple compared to most real estate. You buy land, or you buy an existing facility. You divide it into units, some indoor and climate-controlled, some just outdoor drive-up units, maybe some RV or boat parking. Then you rent those units out.
Month to month, no long leases, no tenant improvements, no fixing a broken dishwasher at 11 p.m. Compare that to owning apartments, where a bad tenant can trash a unit, stop paying rent, and take you 6 months to evict. A storage tenant who stops paying, you put a lock on their unit, and eventually, if they don't pay up, you auction off whatever's inside. It sounds a little cold, but it's built into every lease agreement, and it's exactly why storage facilities have some of the lowest default losses in all of commercial real estate. Now here's where it gets interesting, because the real cost structure of a storage facility is almost boringly simple, which is what makes it so attractive to investors. A typical facility might cost somewhere between $40 and $80 per square foot to build from the ground up, depending on the region and whether it's climate controlled. Operating costs run lean too: property taxes, insurance, a small amount of utilities, maybe a part-time manager or a remote check-in kiosk, some marketing spend, and basic maintenance like fixing gates and repainting doors. That's really it. No kitchen to remodel, no roof leaks over someone's living room, no tenant calling because the heat's out in January. Operating expenses for storage typically run around 35 to 40% of revenue, which is dramatically lower than the 50% or more you'd see with apartments or office buildings. So where does the money actually come from? Rent, obviously, but the beauty of storage is how the math stacks per square foot. A single unit might rent for $1.50 per square foot per month in a mid-sized market.
That doesn't sound like much, until you realize a facility with 50,000 rentable square feet at even 75% occupancy can throw off close to $900,000 a year in gross revenue from a property that might have cost $4 or $5 million to build. Because expenses are so low, a huge chunk of that revenue drops straight to the bottom line. Net operating margins in self-storage regularly hit 50 to 70%, which is one of the highest margins you'll find in real estate, period. There's also a layer of ancillary income that most outsiders never think about. Storage operators sell locks, boxes, and packing supplies right at the front desk. They push tenant insurance or protection plans, which can run $10 or $15 a month per unit and cost the operator almost nothing to provide, since it's usually underwritten by a third party. Late fees, administrative fees, even auction proceeds when someone abandons a unit, all of it adds up. On a decent-sized facility, ancillary income alone can add tens of thousands of dollars a year, essentially pure profit layered on top of rent. But, and this is the twist a lot of new investors miss, the real profit engine in self-storage isn't the rent check. It's something almost nobody talks about outside the industry: annual rate increases on existing tenants. Most people who put their stuff in storage are what the industry quietly calls sticky customers. They forget about it. They don't want the hassle of moving everything again. So facilities raise rents on existing tenants every year, sometimes 8, 10, even 15%, and the vast majority of tenants just pay it. They grumble maybe, but they don't move out. This is where a lot of the real wealth gets built, not from chasing new tenants, but from squeezing a little more out of the ones who are already there and too comfortable or too busy to move. Now, let's talk about who actually makes money in this business, because it's not always who you'd expect. The biggest winners tend to be the large public operators, the ones with thousands of locations and the data to know exactly how much they can raise rent in any given zip code before people start leaving. They also get better financing rates because banks see them as safer bets, and some of them are structured as publicly traded real estate investment trusts, which lets everyday investors buy a small slice of the industry through the stock market without ever owning a single physical unit. Small independent owners can absolutely do well too, especially in secondary and rural markets where the big players haven't bothered to show up. But here's the catch. A lot of small investors get into storage because they hear it's passive income, and then they discover it's passive right up until it isn't. Vacancies happen, break-ins happen, local competition can undercut you overnight if a new facility opens 2 miles away and starts giving away the first month free. Climate control isn't optional in a lot of markets anymore. Customers expect it, which means retrofitting an older facility can cost hundreds of thousands of dollars nobody budgeted for. Let's run through a realistic example, using composite numbers based on typical industry figures. Say an investor buys a 100-unit facility for $3 million. They put down $600,000, financing the rest. Average rent across the units comes out to about $110 a month, and occupancy sits at a healthy 85%, which is pretty normal for a stabilized facility. That's roughly $112,000 a year in gross rental income. Plus another few thousand from insurance and admin fees. Subtract operating expenses at around 40%, and you're left with close to $70,000 in net operating income. After the mortgage payment, the owner might clear $20,000 to $25,000 a year in actual cash flow. That doesn't sound huge on its own, but remember, that's on a down payment of $600,000, so you're looking at a cash-on-cash return in the range of 4 to 5% in year one. The real money shows up over time, as rents increase annually and the mortgage balance gets paid down, plus whatever appreciation the property picks up if the local market grows. 5 to 7 years in, that same facility could realistically be worth 40 or 50% more than the purchase price, especially if occupancy and rents both climbed steadily. The mistakes people make are almost always the same 3 things. First, underestimating how location-dependent this business really is. A facility in a growing suburb with rooftops going up nearby is a completely different animal than one stuck in a shrinking small town. Second, underestimating competition, because storage facilities are deceptively cheap to build compared to apartments, which means new supply can flood a market fast if demand looks good on paper. And third, treating it as truly passive when it isn't, especially in the first couple years, when you're still figuring out pricing, marketing, and how aggressive to be with those annual rent hikes. So is self-storage the secret path to easy wealth that some corners of the internet make it sound like? Not exactly. It's a genuinely strong business model with real advantages: low overhead,
Low tenant turnover risk, and margins most landlords would kill for. But it still comes down to the same fundamentals as any real estate play. Buy in the right location, understand your market, run the numbers honestly before you sign anything, and don't assume the checks show up automatically just because you own some fenced-in dirt with a gate code. The people who win in this business aren't the ones who got lucky. They're the ones who treated boring, unglamorous space like the asset it actually is. If you found this breakdown useful, you know what to do. Like, subscribe, and let us know what business you want us to break down the economics of next.